Hey there, I call myself an RIA, which is usually known as a registered investment advisor, which I was for a few years, but now I still call myself an RIA, but now I'm a recovering investment advisor, right? I'm no longer registered, I'm recovering. And there's a big difference, right? Because I realized that Wall Street is not out to help you. They're actually out to make fees and to go after their own interests. And it's not bad, we're all after our own interests, I get it, but it's almost like when I worked at this firm, I realized that Wall Street was like peeking behind the curtain in The Wizard of Oz and seeing the man behind the curtain, right? That it wasn't actually this big image that was presented, it was something totally different. And so, your advisor really will not help you get wealthy. In fact, I haven't seen anybody getting wealthy using traditional finance. I've seen some people maybe preserve wealth, but it won't really help you to get wealthy, and you have to deal with a lot of volatility. So I want to ask you this question. We'll bring a little humor into these videos. Why was the stock trader electrocuted? He shorted Tesla. So anyway, just a fun little humorous thing there as well. In 3 easy steps, we're going to go over this. Got a great quote for you at the end. Let's jump in. All right, so welcome. My name is Bronson Hill. I'm the CEO of Bronson Equity. We do educational videos like this. We also have, we've raised over $40 million for retail assets such as ATMs, car washes, oil and gas, other sorts of alternative assets. I'm a passive investor as well. I am not an investment advisor, as I mentioned, anymore, so this is just educational. First thing I want to talk about is hidden fees. Wall Street has all kinds of hidden fees. Tony Robbins, who I follow, he had a book called Money Master the Game. And basically in it, he says that mutual funds will typically say their fees are around 1.2%. But he said there's all these hidden fees that they do not have to legally disclose. And he said when you actually look at them, it's actually right around 3.2%. Right? So that's almost triple the amount of fees of what they're stating. Now, in addition, if you have an investment advisor, I know a lot of wealthy people that have investment advisors. They've got somebody at Morgan Stanley or one of these big groups, and they're charging another 2% on top of that. So that's basically 5.2% of, that's just annually. No matter what your portfolio does, if it goes up, goes down, there's all these hidden fees there. And the average return in the last 150 years, there's different ways to calculate it. If you include dividends, about 9.1%. But that doesn't really include the down years. They just kind of average it out. If you lose, let's say you were to lose 50% of your investment, you need 100% gains to get back to where you were. So it's actually, if you count the down years, the volatility, it's probably more like around 7%. So if your annual returns are about 7%, including the down years, and these guys are taking 5.2%, which is about 85% of your total returns, this thing just becomes a bank account, right? And you have to suffer through the volatility of this stuff going up and down. So that's the challenge, and that's really what it is. It's a misalignment of interest, right? There's a total misalignment, right? The Morningstar, which is a research group in Wall Street, they did a study of 7,108, very specific, 7,108 investment managers, and they found that 4,643 of them had $0 invested in the funds they managed. That was 65%. There's a pretty large sample size, over 7,000, and 65% of them didn't have any money in the funds that they actually managed, right? So it's incredible misalignment of interest. You could lose 50%, like many of you did, or I did, in 2008, 2009, and these guys are still getting paid, right? So there's a misalignment of interest. Syndicated deals, such as the multifamily deals that we do, such as some of these other deals, we always try to invest something in the deal with our investors. And it's a way to create alignment of interest, right? The alignment of putting these together to be able to help. So the last thing I want to say about this is that real assets are better, right? There's Wall Street and there's Main Street, right? Wall Street is financialized assets. They'll take an asset and sell little paper shares of it. And then there's real assets, right? Things that actually, are an actual property, or they're some sort of business that you actually own. And it's very, very different. There was a time actually between 1929, the stock market crashed 89% over several years, and it didn't recover until, for 25 years, till 1954, and that doesn't even include inflation. It could have been another 5 or 10 years after that. So there was a time where people would look at each other and say, oh no, why would you do stocks? Don't ever do it. It was like no one wanted to invest in stocks because some people had lost so much money in them. And I'm just wondering, with these days, with so many people aging, and I think it's around 50% of the total stock market is just retirement funds, right? So what happens if there's a decline of 20, 30, 40%? Do people start just dodging and going to other assets? It's absolutely possible, right? So I actually want to share this story with you as well. I had a guy who is invested quite a bit with us, And his investment advisor had told him, don't invest in Bronson Equity. There's risk, there's this, there's whatever. And then I looked at what strategy he was doing, and I told this investor who's become a friend, I said, how does that, this investment advisor, they're either not wealthy or they didn't become wealthy through these methods they're talking about with stocks and bonds. So it's interesting how a lot of these Wall Street folks can feel very smug and smart and be an advisor. Here's what you do, whatever. But no one really becomes wealthy through it. Sometimes you can maintain your wealth through that, but you have to deal with a lot of volatility. Look what's happened with bonds in the last 2-3 years. The last couple of years has been absolutely destroyed bonds. And stocks have had a lot of volatility as well. And so it's important to kind of look and see what's out there. So just, as a summary, Wall Street is not looking out for you. Mainstream investments give you a little more control. And they're just assets that you can see, you can touch, you can feel, and they can produce for you versus having to deal with just the volatility and the fees and the misalignment of interests of Wall Street. I want to share this quote with you from Buffett, who is also not a Wall Street fan. He says, "Wall Street makes its money on activity. You make your money on inactivity," right? So you make your money by buying and holding. They make money when you buy and sell and you're moving money here and there and there's new offerings, and that's how they make their money, right? So they want the transaction. They want you to put assets with them. They want you to do that. So I want to share this strategy with you. It's called the private equity roll-up strategy. I think you'll really enjoy it. It's just, you can check out the video up here. It talks about how we lump together car washes, or it could be dental practices or gas stations or different things. You can sell them as a whole at a much higher amount, multiple. So check out that video. And then if you haven't checked out my book, you can see my book right here, Fire Yourself: How to Leave Your Replace Your Working Income with Passive Income in 3 years or less. Check that out on Amazon. You can also go to my website, bronsonequity.com, get the first chapter available there for you to just sample it. And look forward to seeing you on the next video.